Good morning. It is Friday, August 3rd, 2018. This is Kirk Spano. Fundamental trends, margin of safety investing, and Blue Mond Asset Management. Erstwhile, very bad poker player on the professional WSOP circuit. All right, let's see here. Last week, we talked about Tesla. So let's spend just a couple of seconds on Tesla this week because why wouldn't we? Tesla went up like $50 since last week because they only lost $717 million last quarter. When you say that, it's kind of funny, isn't it? They only lost $717 million last year or last quarter. So, I'm going to stand by everything I said about Tesla. I think they're going to have a hard time turning a profit anytime soon. And that ultimately that leads to major dilution and the share price dropping back under $200 a share. I don't think they're going bankrupt. I still think Elon Musk is a jerk. And that's about that. Yeah. So you can try to trade Tesla stock, but I don't know how you would do it. I just really, really don't. I think every time it goes up, it gives more fuel to the shorts, and every time it goes down, it gives more fuel to the disciples. So I just watch it. It's a source of entertainment for me. Like I said, I am going to start writing some articles about Tesla because I think there needs to be a common sense view of Tesla thrown out there, rather than all these people saying, "Oh, they don't make money." So what, man? There's a lot of companies that don't make money in their first 5 or 10 years, right? You just got to look at what's coming. And then the people are saying, "Oh, they're going to change the world. They're going to be the biggest car company in the world." No, they're not. They're just not. So, let's try to find the middle ground. Let's try to figure out what's really going to happen. And if there's a play to be made as an investor, we'll try to make it. But right now, Tesla is a very, very hard stock to deal with. And in the immortal words of Charlie Munger, too hard. This one's just too hard. I don't know. I'm not going to bother looking for the quote. But Charlie Munger has a quote that basically says, "There's some investment decisions that are just too hard for us, so we move on." Tesla falls into that category for me, and I think for most people it should fall into that category as well. But if you want to try to outtrade the computers and the narrative storytellers and the hedge funds and whoever the heck else it is that's trading that stock, have at it. Use your gambling account because right now it is not an investment. All right, let's move on to oil. China rejects U.S. request to cut Iran oil imports. I think we knew that was going to happen. They can't afford to cut Iranian oil imports. However, they do have growing demand, and in the face of that growing demand, you would have thought that maybe the Chinese would consider importing more Iranian oil since other people weren't, but they did agree not to import more Iranian oil. So Iran's going to see fewer imports from India because the refiners don't want to have to deal with the insurance expenses and the banking problems if they keep importing Iranian oil. So they've been shifting to other sources. Oh my gosh, we are at 50. 50 folks. There you go. How do you like that? All right, so there is still going to be a drop-off in Iranian exports. That's going into the winter when we need a little bit less oil. The U.S. markets are stalling out on production. Not that we're producing less or going to stop producing, but the increase in U.S. production for the next year or so is probably already in, because we know that the Permian is going to have a 3 or 4 quarter period where there's a shortage of takeaway capacity. So a lot of the Permian producers have to tap the brakes just temporarily until next summer. When by spring there'll be more trucks, but that still won't help too much. But then, like I said last week, I showed the chart that I think you're going to see some of these pipelines come on a little bit earlier. So, by third quarter next year, the Permian will be pumping again, and you should probably expect another 500,000 barrels a day out of there, maybe 1 million barrels a day. Seriously, maybe 1 million barrels a day by third quarter next year. So, in the meantime, what's going on? A little bit less Iranian oil on the market. We're not increasing for a few quarters. Saudi Arabia has tapped up production to make sure that any shortages from Venezuela and Iran don't spike prices. Russia's doing as much as they can, but you got to realize Russia's oil is expensive, and they don't really have the capital to find cheaper oil, and it probably doesn't exist in their territory. So, they're pretty much capped out too. In the meantime, you have demand rising for oil, at least in the short term, next 3, 4, 5, 6, 7, 10 years, whatever it's going to be. And we have declining wells across the planet. About half of the wells are conventional. They're declining at 3 to 6% per year. So we have to replace 2 million, 3 million barrels a day, depending on whose estimates you're going to use. The unconventional wells, especially the fracking, they fall off big time in the second year, so you got to replace those. All leads to a firm Goldilocks price of oil around. Let's see, anybody else use Goldilocks oil? Oh, there's a thing called Goldilocks oil. Didn't even know that. So you have this Goldilocks oil moment, which we talked about in the spring, and we really only need this. Goldilocks price oil is going to be around $80 a barrel. Right now we're lower, and the traders are in control, but all we need is really one report that says, hey, we're really seeing inventories decline, and we've been seeing that for the last year. And eventually the traders have to go in the other direction. So right now they're trading a range. I watch Forex Analytics, and I hear what they have to say about it when they have an oil person on. They're just trading a range on oil, and eventually it's got to get back to around 80-ish on the Brent for sure. I think it's going to push 80 on the WTI by spring. But I actually think it probably happens sooner. And then you have the short-term spike ability if the Iranians really do mess around in the Gulf, or if we really do decide to bomb a couple of their facilities. It won't take much to get the geopolitical angst to roil the oil markets, and that is why I am still not only long oil stocks, which I think I'll be long oil stocks for a few years, given what's happening with their earnings and cash flows right now, all going up for the most part. And oil, I'm actually long oil, at least for now, until it hits my target in the 80 range, and then I'll probably be done with that and stick with the oil stocks. Give ExxonMobil the benefit of the doubt, right? Because they only missed all of their targets. Makes sense to me. Give Exxon the benefit of the doubt because of stuff they did 20, 30, 40, 50 years ago, which they're going to probably get sued for. So again and again and again, right? And they're not going to get sued for producing oil, right? Because we all use it. You can't sue for that. Judge already said you can't sue for that. And I think another judge will say it, and another judge will say it, and then eventually the Supreme Court will say it. But what you can't sue ExxonMobil for and Chevron for is that, and this information is out there. You can't say it doesn't exist. It's out there. That they knew about changes to the climate, and they hid the information and lied about the information, because hiding the information maybe not completely illegal. Maybe it's just a jerk move, but they actually lied about it. So at some point, Chevron and Exxon are going to have to come up with money for something. Will it be a settlement? Will it be an agreement to help clean up the environment? I don't know, but it's going to cost them billions and billions of dollars someday, whatever agreement they come to with the government. And it's either going to be, hey, give us, governments to say, give us money the way the tobacco companies did for not talking about the bad impact, and we're going to spend the money on fixing the environment. And by the way, we're going to sanction you. or put a $500 billion into alternative energy. Well, whatever the case might be, there's going to be some major transition. It's going to be financially impacting to Exxon and Chevron, and it's going to be very difficult for them to navigate, which is why I say these stocks can go down a lot at some point in the next decade. And I really think that there's a pretty big movement out there to get the corporations, in particular the fossil fuel companies, to focus more on the climate change problem, which, if you don't believe that we have a climate change problem that we're helping contribute to, then I will just call you wrong. And we can argue about it over beer, because everybody solves the world's problems in a bar. But climate change is real. The governments believe it's real, and that's what really counts for our analysis. Because if we're wrong, big deal. But if the governments are creating policy, then we have to pay attention to that. So as an investor, you have to set aside what you might believe if you believe something different than somebody else. But if the government says we're going to make policy based on this particular set of beliefs, you better pay attention. So anyway, Exxon might be down again today. Who knows? I don't watch it that closely anymore because I'm not ready to short it, and I sure as heck don't want to own it. Right? 10 years, look at that. It's 79 today. 10 years ago, it was 80. It's down from 10 years ago by a couple pennies now. Why is anybody excited about this stock? People have been holding this for 10 years. Explain to me what is exciting about this stock. Right? It pays out a 3.5%. 4% now because the price came down. My God. This chart should be screaming at you. Dun, 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 dun. That's what it's going to do. If you own Exxon, I don't know how many times I can make the case that the past isn't the future, and that these guys have so much comeuppance coming that it's going to be a big deal. And we can just look at it fundamentally. Throw out all the climate lawsuits that you're going to have to at least fight, right? These guys have an inventory of assets that aren't that good, but they have tons of not that good inventory. If you don't understand that, you don't understand the company. Take a look at their assets. They don't have valuable assets. They don't. They're expensive to develop, and there's nobody who will buy them. There's no residual value in most of their assets. Now, I will say this, and I'll write about this so you're going to get the inside preview here. I think that if Exxon breaks itself up, which right now they don't want to do, and I don't even think they talk about it, I think they have a chance. I think most of the company has a chance if they break up. They should spin out all of their midstream assets, right? Spin it all out. Exxon should not own midstream assets. They should sell all of their real estate holdings, all their downstream real estate, right? All those gas stations and whatnot, put them all into a REIT, spin it off. Spin it off the REIT, spin off the midstream, keep the upstream together, and have the upstream invest in an alternative energy company, then spin that off too. And then what happens is that the company that takes the brunt of everything and becomes a binary investment, and everybody knows it's a binary investment, is good grief. They can invest in it that way if they want to. So if you split up ExxonMobil into 3 or 4 companies, right? The downstream, the midstream, the upstream, and then an alternative energy company. Then what you're doing, and actually the downstream would probably partner with the alternative energy company. because they have the truck stops all over the country. I'm rambling a little bit here, but follow me. If they spin off the downstream, they have these gas stations all over the country, right? They have those canopies. You make them solar. You have a solar company, you have a battery storage company, maybe you just buy a small one and you give it Exxon's muscle, and you pile all the debt into the upstream company, the oil and gas company. And in fact, you could even spin the gas out. But I think what ends up happening in that case is the oil and gas company takes all the legal challenges, they take all the debt, and it becomes a binary investment on whether the natural gas 10 years out and the oil for however long we have oil can pay all those debts, right? So it probably gets crushed at one point, and then you have a chance to buy it on the cheap. In the meantime, shareholders get the dividend of a REIT holding the downstream assets and a midstream company, which probably be valuable a long time. When we stop using the pipelines for oil, what do you think we're going to put through those pipelines? They're not going to dismantle those pipelines. They're going to clean them up. They're going to seal them again. And what's going to go through there? Come on, somebody give me the quick answer. What's going to end up going through the pipelines in 10 or 20 years? No. Yes! Bob gets it. Water. Absolutely water. We got a major water problem in this country, but we got pipelines that they're gonna stop piping oil in 10 or 20 years. That's what we're gonna use those pipelines for. Now, I'm sure the pipes have to maybe even get rebuilt, but the right of ways exist, so you just replace them. So I think that if Exxon breaks up and Chevron breaks up, now all of a sudden you have some viable components to invest in, but the oil and gas components, they're so heavy in debt. They have legal challenges. Their assets are questionable. They're gonna have to just, you shouldn't even consider what some of those assets are worth. And now somebody gives me a hard time. Phenom gives me a hard time saying you don't know how to value a company. Yeah, look. So when you take a look at the assets of an oil and gas company like these super majors, they don't put the assets right onto their balance sheet. They have a supplement in the 10K, and that is where you find their assets. So you can, there's a value to those assets that they do account for. And what I'm saying is that those are currently written up to levels that they could never, ever in a million years get bought for. Couldn't happen. So the oil and gas industry is going to change. Your Permian companies, I think, are in good shape. I'm long Continental Resources right now because they don't hedge. And if we get a pop in oil prices and really just sustained high oil prices, when they finally do hedge, it'll be at higher prices. And they would really benefit from a price spike in the short run. So I like Continental. That is one of the ones that I talked about. I actually gave away some trades, folks. If you're following the blog, I gave away some trades. So these are trades that members had, Encana being one of our key holdings. But then I did some swing trades. Excuse me. Continental Resources, we bought some calls, Centennial, and Pioneer. Now, we also have leaps. We have longer-term, more conservative calls on some of these companies as well. But I bought some shorter-term calls going to January, just in case what might happen in the Middle East here in the next few months. So that is your oil play of the day. All right, let's move on to everything's changing. Dump old economy stocks. And this is a play on an article I wrote, revamping or starting a portfolio. And I'm going to move some of this stuff up here. We're going to talk about that today. We're going to talk about building a portfolio, how to maintain it, how to trade around the edges of your core positions. Some people call what I'm doing core and satellite. Yeah, I guess kind of. I just look at it as asset allocation. And to make life simple, I break it into quarters of the portfolio. You don't have to. You can break it into fifths, sixths, whatever, turns your crank, eighths, whatever. Um, but anyway, if you're not following Brian Bain, you probably should be following Brian Bain. See, I following, unfollow. I'm gonna unfollow him. I'm gonna follow him again just so he gets the message. Yay! I don't get email alerts from anybody because I follow a couple hundred people. But you should maybe get the email alerts from him. Certainly get the email alerts from me because I don't write all that often. But when I do, I'm trying to say something useful. But Brian did an interview of me, and it's actually I forgot that we did it, and I think I might have been in Las Vegas when we did it. Either that or we did it right when I got back. I just forgot. But it's a pretty good interview, and feel free to comment on it because a lot of people like to tell me I'm wrong about stuff. Some people are telling me that, hey, this makes some sense, but this just goes back to the whole the world's changing, right? So look at the big secular trends. The future is coming pretty fast. The high capital, no moat stocks you got to avoid, right? I don't think ExxonMobil has a moat anymore, right? They have too many worthless assets, too much debt, potential legal problems. So you want to find high ceiling stocks with strong secular trends. You build a position, you be patient, trade a little bit around the edges, and you probably do really well. So embrace the changing world. Understand the smart everything world is coming, IoT, blockchain, edge computing, all this stuff, right? Climate change and climate change policy, right? Like again, you don't have to believe that climate change is man created. It is. You don't have to believe it though. Just got to understand that there's climate change policy. How do you invest that direction, right? So sell the grandpa stocks. And I'm just going to write an article called Sell Grandpa Stocks because somebody else wrote an article telling you to buy grandpa stocks. And I'm telling you, grandpa stocks, you know what that means? Most of our grandpas are dead. Yeah, a lot of these stocks are going that way too. Interesting statistic. I don't know if anybody did a follow-up to make sure this is true, but somebody put out a study a while back that said like 80 to 90% of stocks end up going to zero at some point. And that makes sense to me because I think a lot of companies are either bought out, in which case they disappear, but I don't consider that going to zero. But a lot of companies just become obsolete. And so if you take a look at the stocks that were in the S&P 500 30 years ago, I'd be curious to know how many of them still exist, either via just existing or having been bought out. I bet it's way less than half. So a lot of stocks end up going to zero for good reasons. Don't deal with those companies. All right. Get into some of our companies right now. SunPower. Doing pretty good suddenly. EPS surprised the analysts to the upside, and they've been simplifying the business. They have is it Portland? I can't remember. I think that might be one of the reasons I'm going to Portland. But SunPower bought a plant, bought a Solar World, whoever it was they bought. And they're simplifying their business. They're selling off extraneous pieces. These guys are going to be a big deal. And I'm telling you, only 2 or 3 years away from now, not 10 or 20 anymore, 2 or 3 years away from now, you're going to see a renewed surge in solar energy because what the scientists are telling us about what's happening to the climate and that it's accelerating, the bad things are accelerating, we're going to have to really make some hard decisions in the next decade about how we're going to handle energy infrastructure. And I'm telling you, there's not much downside in SunPower from here. But there's the potential that it could be a 10 or 20 bagger. Seriously, a 10 or 20 bagger. So do you put your money, a little bit of your money in something that could go up 10 or 20 fold because it might go down 30 to 50%? Man, everything can go down 30 to 50%. So make sure that your upside is big because a few of those big upsides will hit. So if you have a portfolio of 20 to 30 stocks, which is what you should shoot to be doing, if you go over 30, you just can't keep track, right? You might as well just buy ETFs and mutual funds. But if you have 20 to 30 stocks with a few ETFs for asset allocation, you have a very good chance of making a lot of money because some of your good ideas will accidentally be great ideas. Just avoid everything in the middle. Get rid of all those grandpa stocks that, you know, you shouldn't just never be excited about something that's going to make. You should never be excited about an equity that's going to make single digits. Period. It's not worth the risk. Not worth the risk. So folks who tell you I'm happy getting my 4% check, you know what? I understand guys like buy and hold 2012. He's worth $25 million, he said. He doesn't care, right? He doesn't care. He owned some stocks during a massive bull market that went up and made him rich. And he started out with money. He made a lot of money, and his investments did great. And God bless him. But for that to happen for you, you better be socking away a whole bunch of your income, and you better be buying the stocks that are going to grow like the stocks that grew 30, 40 years ago, right? Exxon's not going to grow anymore. Chevron's not going to grow anymore. So the small oil companies will for a while, but these are the companies. These are the companies right here. These are the companies that have a chance to go up a lot. Smart something or other, alternative energy, water. And I didn't put water in here, and that's my mistake. I just had a brain thing, but water is going to be a big one too. And here's an ancillary play on water. This is one of our favorite stocks, Nutrien. I've been telling people to buy Nutrien since it was potash, because we were at the bottom of a capital cycle. These guys don't have to reinvest a lot of money into their mines for a while, and the price of fertilizer is going up for two reasons. One, not a lot of new capacity, and two, we needed a lot more. So demand for fertilizer is going to keep trending upwards. It went down for a while, and then they had some supply issues to deal with. They've worked their way through that. This is a company that I wrote about on Motley Fool in 2012. I told people to dump it, right? When everybody still loved it, I told everybody to dump it. Now everybody forgot about it, plus with the name change, and nobody's in it. I'm telling you, buy Nutrien. Why? Huge share buyback, increasing their dividends. Revenues are going up. Prices on their products are going up. They've vertically integrated with Agrium. They've bought a couple of technology companies so that they can integrate with the farming infrastructure better, which is getting more technologically adept. I've told the story about the farmer here who just in my neighborhood who he basically bought some high-tech equipment, and he went to all the old farmers whose kids didn't want to farm the land anymore, said, hey, your kids don't want to farm the land? I'll do it for you. I got a robot tractor. And I think he's got a bunch of them now. And so he's farming all sorts of families' lands because the old folks, the old farmers, they can't do it anymore, but they don't want to move. And they're like, well, I might as well just hold on to it and let the kids sell it, get a step up in basis on the property, right? I mean, it's just, so the whole farming infrastructure is changing. If you're in the farming belts, right? If you're across the middle of the country, you see this. If you're in Iowa, you're in Nebraska, you're in the Dakotas, you're in Wisconsin, Indiana, Ohio, South. If you're in the farming part of the country, you know that these big changes are coming, right? And there's money to be made there as an investor. And frankly, I've been deciding what I want to do with the money I've been saving for real estate. And part of me wants to just buy a condo in Vegas and hang out. But the other part of me says, I kind of want to live somewhere where there's, water. And Wisconsin is one of those places. And there's a lot of cheap real estate here if you get about an hour away or 2 hours away from the cities. And I think that's probably what I'm going to do. Probably going to buy a hunk of land, hopefully some crummy farmland, and then I'm going to create, I'm going to change it into orchards because, I don't want corn. I don't need soybeans unless somebody else grow the corn and the soybeans. I want apples. And I wrote a paper uh, that said that peaches are viable in Wisconsin and was told I was wrong. And then 5 years after I wrote that paper, they said, hey, you're probably right. So, now we can grow peaches in Wisconsin. So maybe I'll grow peaches. I own WisconsinPeaches.com as an aside. If anybody wants to buy it and sell fruit baskets, let me know because I ain't going to do it. All right, let's go to another company that we love. Hey, Sierra Wireless. What did we say about Sierra Wireless while we were accumulated in it this last 6 months? Said in this in the second or third quarter, fourth quarter, sometime in the second half of the year, they're going to have a surge in earnings and revenue. And what did we find out today? A surge in earnings and revenue. Sierra Wireless is a big deal. Somebody mentioned it in a Seeking Alpha article. I'm going to write about Sierra Wireless. I'm going to ask for help here at the end of the show too. But Sierra Wireless is a great stock. I still think it's going to go to $40 to $50 a share. We were selling the $17.50 puts. A whole bunch of them got put to us recently, and people wanted to write covered calls, and I said, don't do it. Don't write covered calls on something that just got put to you when you sold a cash secured put. The whole reason you sold the cash secured put was not the income. It was to get a lower cost basis. So when Sierra Wireless was $16 to $17 a share, we're selling the $17.50 put, meaning that we expected it to get put to us. If I didn't want to get put to us and I was just to add some income, I would have sold the $15 put when it was $16, right? But when I sell the $17.50 put, that means I kind of think it's going to get put to me. So we were collecting about $250 on those puts. We have a cost basis on Sierra Wireless of about $15 a share right now. Most of us should, right? I'm going to take a look here. Anybody who's in Sierra Wireless, did you get it by selling a put or did you just buy it outright? And what's your cost basis? If you can post that, that'd be great. I'm just curious. This stock is going to just keep on running. So if it has one of those little halfway Fibonacci retracements, probably maybe so from 1620 to 1920, you probably get it around 18. I mean, my guess is it comes back to around 18. So, because it looks like it's already topping off today. And I've been watching it for about an hour. So it opened up, and it's kind of chopping along. One thing that you should know, and this information's out there too, something like 80 or 90% of all stock market volatility occurs when the market is closed. So you either wake up with something up or down, and then it chops along during the day and the day traders play with it. So the big moves are made before the market is open or closed. So what does that mean for us? The effective use of these options is killing it for us. So I would suspect that we got all kinds of people who are up 20% this year, 25% this year, because that's about where I'm at. And I can't be as aggressive as some of you can be, right? Because I'm regulated. So yeah, somebody said average cost 16, average cost 1583. Yeah, my cost basis was actually right at 15. So because I got in, I suspect it's because people hear me now and they believe me later. But yeah. So if you want to get into Sierra Wireless, here's what I would do. If you're not in yet, wait for it to come down about $1. And then when it's around $18 a share, don't buy it. Sell the $20 put. You'll get about $3 for it because you get time value and volatility. So that'll knock your cost basis all the way down to around 17. All right, so we're going to talk about cash secured puts right now since this is a good spot to do it. Who should consider selling cash secured puts? This is over to the CBOE. This is a great piece. Write this down. This is something that you should do. Who should consider selling cash secured puts, right? In general, and they give you some examples, right? In general, you want to sell a cash secured put if and only if you're willing to own the stock at that strike price minus your premium. Don't ever sell a cash secured put like on Exxon because we don't want to own Exxon. Right? So A cash secured put is a way of becoming a long. Keep that in mind. That's what we're really trying to achieve. And the fact that we're generating income, we're getting paid for time value and for volatility, right? We're receiving something for the time value and the volatility, which ends up giving us an advantage on cost basis. And what do we know about cost basis? The lowest cost basis wins. You want to buy as cheap as possible. So if you can use this derivative to get paid for time value and volatility and other people's speculation, you should do it, right? You're receiving something literally for nothing. To me, it's one of the easiest deals that you can make. This is a professional move. This is what guys like me do to squeeze out a percentage point here, a percentage point there, a percentage point here, there, the other, everywhere in a box with a fox, you know, and we end up making extra money because we don't have to, you know, we don't, it's just extra. It's just falling to the bottom line, right? And we're not accepting any more risk. There's no more risk to this than buying the stock, right? Because if I had bought Sierra Wireless, at, let's see here. If I had bought Sierra Wireless at, let's see there, $16.95. What's my risk? $16.95. But if I sell a $17.50 put there and receive $2.50, what's my risk? 15, right? The $17.50 strike price minus the $2.50 premium. So my risk is only 15. But I'm still probably going to own it because it's in the money, right? Because I'm still way below the price. And that's what happened. So in here, we were selling the $17.50 puts. Got put to me in June and July, right? Just a couple weeks ago, or 2 weeks ago, and then a month ago. So I had all these June, July puts put to me. And people are like, oh my God, I got Sierra Wireless put to me at $17.50. Yeah, how do you feel about it now? Right? Because really your cost basis was, as these two guys say, $16. So another one, 1607, 1583. So if you're not a member of Margin of Safety Investing and you're take a look at the chat right now, 4 or 5 people have posted their cost basis were all around $16. Why? Because we were selling the cash secured put rather than buying it around 17. Now, there was the perfect spot to buy it at 1570. Are you perfect? I'm not. Once again, ask my ex-wife. So if you're just selling the puts along here and realize that you're not perfect and you don't know that you can get that perfect spot right there or that one there, right? And just in here, you're like, okay, on a down day when there's volatility, I'll sell the put. And then it gets put to me. And then our thesis plays out. Earnings and revenues go up. Right? I hope this is helpful to the newer folks and to folks who are trying to wrap their head around selling cash secured puts and why you do it. You do it because you're setting some parameters. You're getting paid for time value. You're getting paid for volatility. You're getting paid for other people's speculation. And you don't have to be perfect. And in fact, you know, like I said, so the perfect price to buy here was $15.70. And all these folks with cost basis around $16 by selling the cash secured put. They were almost perfect. And in my case, I got a little bit lucky. My cost basis is like 1501. So, you know, sometimes it works out so you're better than perfect. All right, we're going to go through some questions. And I know that if you've been posting questions here, I probably missed them. So let me go and scroll up, take a look here. If the Permian and other oil fields are going to have pipeline shortages for the next 6 to 9 months, can you explain your rationale behind oil stocks going up? Price of oil goes up, right? So they're going to have a higher realized price. They don't have to produce more, right? Because if they're not drilling, they're not spending money. But if the price of oil goes up, they're making more. right? So that's why. That's why the oil stocks will go up, is because even if they're not pumping more oil, they're getting paid on the oil that they're already pumping, and they're not putting more capex in. So they just have more falling to the bottom line. And then when they can pump more, it'll be even better. Iran readying massive military exercise in the Persian Gulf. All right, let me posit something here to you. Iran sending military vessels into the Persian Gulf. Any possibility in anybody's mind that Donald Trump doesn't like that, President Trump doesn't like that? Anybody think that maybe he talks to his generals and says, hey, what can we do to offset this? And I'm going to tell you something else. I'm a pretty keen study of human psychology. I'm not predicting this. However, it seems to me that there's a probability that's not inconsequential, right? So there's a significant enough chance that something might happen that the United States would attack certain facilities of the Iranian government. Missile facilities, suspected nuclear facilities, key military outposts, maybe some of their ships in the Persian Gulf, right? So if we can completely avoid involving their population and hit them militarily where it counts, could anybody else see President Trump doing that? I don't think the odds are zero. I don't think it's 100% either, but I think it's possible enough that it could happen. And from a poetic justice standpoint, given that Iranian money helped fund quite a few of those Saudi terrorists, I could see something happening around September 11th. So I'm not saying it'll happen. I'm just saying when you take a look at these things and you try to think out many, many scenarios, what could happen, and then one hits you in the head and you're like, oh, man, I hope that doesn't happen, but I could see that it might. You got to keep that in mind. So that's why I'm long on oil, just in case. I don't think there's much downside, but I think there's significant upside. And that is something that I will come back to over and over and over again, and it is the way you should think about investments. If you can limit your downside and still have significant upside, some of those significant upsides will happen, right? The old Peter Lynch thing. Just don't make a lot of bad decisions. Buy a lot of good stuff. Some of them will become great. You don't know which ones, right? Because we're not perfect. All right, so that is that question. Would you consider UTX and Boeing? No, I don't. I think Boeing is an expensive stock. I don't know that it's a grandpa stock. United Technologies I like too, right? So these are companies that have some moat around their business, right? With Boeing, they're basically a duopoly, right? There's only two companies making what they make, really. And, them and Airbus. So as long as air travel is increasing and we have to replace airplanes, and we do, there's a lot of old airplanes out there. They got to be replaced if these companies are going to stay in business. So I don't like the airlines anymore, right? We've gone through that period with the airlines, but I think the airlines, you have to now pick out piece by piece, company by company, and say, okay, which companies already have the newer airplanes and the good routes? And they'll probably do okay. But all these companies, some of the legacy carriers, they have really old fleets, they're in trouble, right? Because they're not going to have the marginal ability to generate drop to the bottom line revenues like some of the newer carriers. That's why Southwest does pretty well. They have a lot of newer airplanes. They had a couple that had a problem. They'll replace them. But, you look to the airline companies that have the newer airplanes, and they'll probably be the ones that do the best. You have to take a look at what their CapEx expectancies are. What do they expect to spend? But, yeah, so United Technologies, they're into a lot of things, so I don't worry too much about them. But there's definitely cyclical, right? They've been drifting upwards. Let's go here. They used to be cyclical, but look at that chart. Whew. Will that chart keep going and going and going? I don't know. You tell me. Are they running up to the point where they've satisfied all the demand that they can handle? I don't know. And then if they have, can they keep adding to their margins? Probably not, right? So are they a bad company? No. Do they have some protection around them? Do they have a moat? Somewhat. Um, do they have unlimited growth potential? No. But are they in some of the high growth parts of the world? Yes. So a company like United Technologies, I guess I would consider buying after one of these big corrections, right? After a big correction, I think I could buy them. Same thing with Boeing. Look at this chart. Bought them when they were $60 a share, held them into the hundreds. Don't I feel dumb? I sold them in here. I'm so dumb. 347. What the heck? Now, does that chart make sense to anybody? No. This makes sense. This is going to probably go sideways and drop at some point. I will say that Boeing will probably you'll get a chance to buy Boeing around 200 whenever the next recession comes. So I wouldn't buy it now, but I wouldn't call it an old man stock because what did I say the old man stocks were? Old man stocks for companies that have too much capex to generate revenue and incremental revenue, and they don't have any protection around their business. Boeing is the epitome of having protection around their business, right? It's one of the reasons I got into AT&T, CenturyLink, and Verizon here. These stocks have gone sideways, and people would say, well, that's an old man stock. You're buying an old man stock. No, they're part of an oligopoly that I believe is going to raise the price of access to the internet because they should, and they're going to make more money. So AT&T just raised some little fee from like 95 cents to $1.75. I don't even know what the fee was. Nobody noticed, but it dropped $1 billion to their bottom line. And they did it with something else too. And they're raising the rates on DirecTV Now, which is a great service. The cord cutting is eventually going to be good for companies like AT&T. I think especially AT&T because of the Warner purchase. So, I take a look at this stock, and I think that we're going to see another one of these, right? It's been range bound for 20 years, but look at this. From the early 80s to the late 90s, I think we're going to get another run like that with AT&T, and that the new range will be, it'll push 60 at some point. I think this one's going to double while it kicks out that huge fat dividend. So there you go. That's what I think. McDermott, somebody asked me about McDermott. I like the CBI purchase. I think this company is a company that you can buy on value. I would wait till the next recession. It's another company you only buy in a recession. And I think that there's probably new members I have to keep remuting. I think there's probably some upside to these guys when we come out of a recession. So we'll have to analyze it then. I know they're cutting fat now. They have quite a bit of debt. So I'm not real keen on companies that are debt laden because I think the capital is going to be harder to get in the future. Although when the next recession comes, I'm one of the guys saying that I think we're going to get helicopter money. I think the governments and the central banks are just going to say, you know what, we're bailing freaking everything out. We're bailing out pensions, we're bailing out student loans, we're bailing out municipalities, and we're going to rebuild the water and energy infrastructures around the world. I think that's what's coming. And when it happens, I don't even know that it's an if in my mind, but I'm I'm almost positive we get helicopter money, and that's what they do with it. If they give it to the banks to just do what they want with again, we should all start, mugging politicians. Seriously. So the reality is that there is a fix to all these problems that are out there. We need to vote for people who have the brains to fix these problems. And right now, there's a bit of a brain drain going on with Washington, although there's some new good people getting in. But there's economic ways to fix all this stuff, and it's not even hard. It improves standard of living. You know, the world is not a zero sum game. Everybody should be doing better generation to generation. And when that doesn't happen, it's because we're screwing up, not because the system is bad. It's because we as people are doing dumb things or greedy things or mean things. So we can make this all work. All right, there's my kumbaya moment. Broadcom, somebody asked me about. Um, what I don't like about Broadcom is that they are so financially engineered that I worry about what's going to happen to them when a merger goes bad. And I think that this turnover here is representative of what I've been worried about. I could see them chopping along for a very, 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 very long time. And I could even see them having a digger, right? So if all of a sudden they are under 100, I'd probably take a look. But it's just not worth my time. Now, I talk about all these stocks that could lose 50%, right? And people say, it couldn't happen. Couldn't? Really? Are you sure? You don't think an awesome company could lose 50%? I don't know. This one did. Here's another one that's lost 50% a couple times. Yeah. And it did for crap. So 22 to 12, 95, 64, so 30%, 130 to 99. And these are split just so I guess Apple's only lost 30% a couple times. So the best company in the world maybe has lost 30% a couple times. Has Google ever lost 30%? No, Google's pretty good. And I talk about Google being the best company in the world, and that kind of makes me think that I might be right. So what's a company that lost 50% that nobody thought would ever lose 50%? Uh, whoops. There's one. High price, all time, 60-ish, down to 13. Still in business. Would you want to have owned them? You pick any number of companies that have gone down a whole bunch. And it's just not even questionable. They can drop 50%. And if you think it might happen, you need to get out of the way. That's all there is to it. NXP Semiconductors, now that the merger with Qualcomm is off, I've been thinking about these guys. And I don't know what they're worth. I'm going to have to figure that out, aren't I? 95. So will somebody else make a run at them? Probably. Will China cooperate? Who knows? Right? Decent debt ratio. They're in a really strong industry. They have some awesome technology. My guess is somebody else makes a run at them. They're only $32 billion, right? Only $32 billion. I think somebody could make a run at them. This company here, maybe these guys, they could afford it. They could absorb NXP. Now, will the government, will China and the United States DOJ allow it? I don't know, but NXP seems interesting to me right now. That's all I say. They weren't on my list because they were getting acquired. Oops, I messed that up. What did I put in? NSP. Oh, what the heck? I forgot the symbol. Getting old. Getting old. Every week, gotta remind myself I'm getting old. Oh, killing me. The speed of the internet. Speed of my brain and clicker for NXPI. Forgot the I. Yeah, so anyway, I think that if this comes back even further, if it gets down into that 70, 80 range, I really have to think hard about it, right? So it's on my radar list. I know we have a couple resident semiconductor experts, so if they can give us some answers about why these guys are special, that would be awesome. Company that hit my technical radar. Shopify, company that's been on our list a while. It's down at the 200-day moving, well, not quite, but getting close to the 200-day moving average, bounced a little. I think that if you have a six-figure account, you can start thinking about selling cash secured puts on these guys. So you should learn about these guys. I put them up on the chat room the other day. I just put a link to their investor site. I'll tell you what, these guys are a pretty cool company. Every bricks and mortar company out there has to have a web presence. And these guys are the leader of taking people to the web. So I have a client who sells yarn. She travels to sell yarn. Cool lady. And she told me that most of her customers that have survived have taken their bricks and mortar store and added a really great website. And she says that most of them have gone through Shopify. So we are still actually in the early innings of converting to an economy where you go to the store or order online or do both, right? And I think that there's models for businesses where they have a destination store where you can try things on or see things or touch things, experience things, and then say, okay, I want to customize it to me. Let me order it online, and day after tomorrow I'll have it, right? So a lot of things can just be shipped from a central location. Then there's other things that have to be built. You say, okay, well, I want to customize this. Think of it like a car. The day of going to the dealership and saying, what do you have on the lot? Or can I order something from the factory or from another dealership? Those days are slowly going away. Tesla is pioneering the order your car how you want it thing. Go online, pick out your components, and order it. Right? We're going to charge you $1 million for it, but in the future, customization of almost everything is going to be available via these types of websites that Shopify builds. So I like Shopify. I think that I want to try to buy it. I like this pattern. I want to see what happens in here. They're starting to make boatloads of money. And I just want to see if it's got one more leg down. Because if it does, and it might not, but if it does, it'll be a doozy. Right? So, this stock for sure could go into the 90s. No doubt in my mind it could. I'm not saying it will. I'm saying it could. And remember, this is a stock that Motley Fool has been pumping for a couple of years. So Motley Fool started buying it in here. Oh, actually, I take that back. I think Motley Fool was buying it way down in here. On this ramp up, that was Motley Fool. Because they were buying it right around 65. And they still pump it. So now that it's gone down, where's the bottom? Well, a lot of investors aren't going to want to see lose their gains. So I'd say this is a stock that very well that could get into the 90s. So we'll keep an eye on it, but I like the company. Somebody asked me about this company. I don't know anything about it, but it did just jump. I never even heard of it. But they make flanges. This is the one that has flanges. You make flanges, you're on the cutting edge. Box. This is a stock that came into my firm. 2 different new clients had it in their account. They had written it up. I actually did sell it right before it dropped, so that's good. Now, what I'm trying to figure out is, do these guys have artificial intelligence technology that somebody else wants to buy? because as a pure cloud-based platform, that 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 world is starting to get saturated, a lot of competition. But they do have some niches that I think will be profitable, but they're not there yet. So we really need to see their sales continue to go up. And then we have to assign a value based on do we think that they are going to get acquired for artificial intelligence that they own, which is, from what I can tell, as being a layman plus on that stuff, pretty impressive. All right, we talked about cash secured puts. All right, had the unemployment report today that was pretty boring. Anybody else got any other questions? Let's finish up with questions and be done in an hour. Then why don't we also buy the pipelines? I do. I own Kinder Morgan. I love Kinder Morgan. Told you, Kinder Morgan's going to double. ETP is okay. You want the pipeline companies that are becoming corporations, right? Because you can hold those in your IRA. You can hold those anywhere. The MLPs you really don't want in your IRA because of the business related. I don't know, some tax issue, business related income, BTI, something like that. But we do own some pipelines. We own Kinder Morgan. Thoughts on recent volatility in solar stocks? Yeah, I just think that the future isn't here yet, and people don't always see the future, and it scares them. Change scares people, so they don't buy it. SunPower got beat up, and now we're learning that they probably shouldn't have. Earnings announced by Antero Resources. Oh, this one's the bane of my existence right now. So Antero Resources. I like Antero Resources. I've owned Antero Resources. I'm getting my butt kicked on Antero Resources this week. For folks who want to sell puts, here you go. Here's your moment to sell puts on Antero Resources if you don't already own the stock or have calls. We were supposed to be getting big draws on natural gas, and I think that's still going to happen, but these companies are really struggling with the pricing environment. So, I'll be honest, President Trump's been bad for natural gas. He's been good for coal, but bad for natural gas. I own Antero Resources because they're a great company. They hedge very well. They've been protecting themselves through this, and someday we're going to get rid of coal. We are. We're just going to stop using coal. I don't know if we'll give it a 5-year lead or what we're going to do. But coal is going to be climate change policy, I'm telling you. The end of coal is coming, and I'm going to short the hell out of it when I get the signal. But when that happens, correspondingly, natural gas should fly. So I don't know if people are aware of this, but natural gas in the United States, we use slightly more of it now. This is new in the last couple of years than coal. Around the world, still a lot of coal. Here's the legislation that I expect. In the next 6 years, 7 years, we're going to get a piece of legislation that says this. No more coal exports for the United States, and no more coal power plants in the United States. That's how they're going to kill the coal industry. And they're going to say to China and everybody else, hey, we're not going to send you coal in 5 years, but we will help you convert everything to natural gas. And if you want our natural gas, we'll sell you that instead. Why would we do that? Because we can cut the emissions from power plants. Switching from coal to natural gas cuts the emissions by half. That's how you do that. So you immediately cut your emissions by half. And then as cars go to EV over a couple decades, you get rid of all those emissions too, right? So I think it's going to take to the middle of the century before we're down to 50 million barrels of gasoline or of oil per day, right? Right now we're at 100 million barrels a day, give or take. We'll cut that in half over the next 3 decades. So we will cut our emissions from cars in half, from oil in half, and we'll cut our emissions from coal in half. That should be enough with the advent of methane to plastic technology to allow us to keep our cows and pigs that fart that we think are delicious, right? So, all the people who say become a vegetarian because it's ruining the environment, no, why don't we get rid of coal instead and switch to EVs so that I can eat my cow? There you go. That's what's coming. It's going to take a very long time. Antero is probably a buy right now, but it still, as an owner, pisses you off. Right? The private equity firms, this is another one of our plays here, super high dividend stock. GameStop. My thesis on GameStop is pretty simple. I think that they still have a huge foothold in that business. And I think that they can convert it to subscription based. And I think they can do it by having destination style stores rather than the little Radio Shacks. Because they bought like hundreds of Radio Shacks. They're too little. They need to go to destination style stores where you go, you test out a game, you play some VR, and you go, oh my God, this is awesome, and you download it. And you download it from these guys because you have a membership and you get points and you had fun at the store and you can't wait for the next one. That's what these guys need to do. That's why I own them. And while I wait, they're paying me a 10% dividend that I'm pretty sure they're going to keep because they're not particularly high debt, right? And their revenue is still plenty high to cover the dividend, so I don't worry about it. Plus, they have something like 60 or 70% of their stores are coming off of lease in the next 18 to 24 months. So they have all these little bitty stores that they can get rid of and then convert to bigger stores. What if they went out and bought the Toys R Us's that are laying all over the country? Converted those to GameStops. Hey, Mr. CEO, did you hear me? Buy the Toys R Us out of bankruptcy. Not Toys R Us per se, but maybe buy the name too. And have stores that are half Toys R Us, bring that name back, and have GameStop buy all those stores, create a REIT, right? Have the REIT separate. So you have two entities, a REIT and a toy and game and video games and collectibles, which is growing 25-30% year over year. And do that. And then instead of having stores and strip malls that nobody goes to, have the big stores with video gaming and with virtual reality centers. And you can basically be open almost all the time because during the day you have regular hours and then at night you have events for kids to go and play. Right? This is not hard to figure out. If they haven't figured this out, I mean, I sent 2 CEOs ago, I sent a letter. Maybe I should send the letter again. It's probably sitting somewhere or got thrown out. But I mean, like letter, I wrote it on paper. So maybe I should send it by email. But I think that this is a good consolidation. We know the private equity firms are sniffing around. I would hate for these guys to get bought out at 17. It would piss me off because these guys should stay as a public company, and they could really, really tie it up, really do well. The problem with private equity taking these guys over is they'll load it up with debt, they'll suck all the money out, they'll pay themselves obscene amounts of money, and then they'll spin it out as an IPO because they'll hype it up, and then they'll IPO it at 36, and then the damn thing will crash again because they loaded up with debt. So that's the worst enemy of this company is private equity, and because they'll just take advantage. What they really ought to do is what I just described, and I think they're smart enough to figure it out. I mean, the founder is still involved. That's the GME story. What did you buy, Pioneer? Somebody bought Pioneer calls. Well, what the heck did you pay for them? I've been buying the Pioneer calls specifically because of earnings coming up. So somebody asked, should I get rid of my Pioneer calls? Well, what did you pay? Did you pay more than I said to pay for? Why is this not working? Pioneer. Good grief. Yeah, I don't know why they just dropped today. I haven't read up. But this is what I don't know. What did you buy them for? Yeah, I gotta think that somebody overpaid for their calls. Iran, serious intel westward, something military having. Yeah, I know. Calyx, long term, love them. They're gonna okay. So you remember the Sierra Wireless chart? Calyx is gonna do that eventually. Same reasons, I think. XLV, yeah, I mean, if you're gonna hedge, there you go. Don't overpay for hedges and don't go in big. I tell people all the time, teeny tiny positions, scale in. Don't buy just once. You're not perfect. Buy a little at a time over time. MNK, Mankind, is that who that is? Why am I not getting Melencroft? I haven't studied these guys. I don't really know. But I don't like most companies in healthcare. Are they doing something in particular? Generics, branded? Do they have a blockbuster? Is there something that's going to be a blockbuster? I don't know. I don't know what's going on there. Bloom Energy, yeah, keeping an eye on them. I think Bloom Energy is going to be a big deal. Holy crap, you guys! 28 more messages. T2, yeah, good reports. Um, so very teeny tiny specs position in this company. Have not expanded it. Yeah, they've been hovering. Yeah, chop, 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 chop. They said $50 million in revenue by 2020. I think they are soft pedaling that. I think that the estimates they're giving, they're going to crush because it doesn't make any sense why they would get to that, but not much higher, right? So I think that this is similar to Exact Sciences in setting the bar low that they'll be able to hurdle. The difference is that they don't have anywhere near the ultimate upside of Exact Sciences, which, since I was a big bull on this a while back, let's take a look at Exact Sciences. So Exact has been getting the crap kicked out of it. My buy price on this stock is significantly lower. I set it at 31 bucks a share. I could see starting to nibble in around 40, 42, right in there. But we have a bottom feeder price of around 31. This rally here, about 31. So Exact Sciences, the problem is that their growth curve is not curvy enough, too flat. So they're growing, but it's not accelerating growth, and that's a problem. If you want to have a really high PE, you have to have accelerating growth or big, big numbers. Yeah, everything will get crushed going into the next recession, but going into the next recession, oil will do the best. So you ride it up. You want something that's going to skyrocket going into the next recession, it's going to be oil, right? Because we're going to accelerate, 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 pop. Look at every recession out there. Oil goes up, then the recession, then it follows. Oil is the epitome of riding a rally up. So keep that in mind. That's what oil is good for. Plus, we have all these other factors. Plus, what if I'm wrong and the next recession isn't for 10 years? I don't think I'm wrong, but we'll see. It's up to the Fed. Fed needs to slow down. Google. Oh, there you go. Google did have a 50% digger a long time ago, long ago. Nope, I don't like Amazon. No, when I say I don't like Amazon, I don't mean that I don't like them. I just think they're expensive. It's a dumb looking graph. 1827 earnings, 12.62 a share. Let's give it a PE of 50. Where's my calculator? 50 times 1272. Right? Just do these exercises. Now, PEG ratio. Let's look at the PEG ratio. I think it's here. PEG ratio was a favorite of it was PEG ratio. Here he goes. PEG ratio. We got the forward-looking PEG ratio. See that? What the heck is their growth rate? So PEG is PE divided by growth. I can't imagine that's right. Well, that's attractive if it's right. I can't imagine their growth rate is really over 100%. PE ratio forward is 105. To justify a PE ratio of 105, you would need 100% growth because you want a PEG of around 1. Oh, this is trailing 12 months. Okay, so we want forward-looking PEG. They don't have that. So we have to calculate it ourselves. Forward PE ratio of 100 and revenue growth. So that's 25%. Yeah. I'm looking for growth. God damn it. Growth, revenue growth. There we go. Year over year, 39%. So you've got a growth rate of 40% and a PE of 100. So that gives you a PEG ratio of 2.5. That's too high. You need a PEG ratio in the ones somewhere. So I just think the Amazon's too expensive because they're certainly not going to start growing faster. How would they do that? If Bezos pulls that off, God bless him. But I don't see how a company that's grown this much, this fast, for this long, can keep doing it. Maybe I'm wrong. Well, it seems risky to me. Any comments on Motley Fool in general? I don't think much of their research. You know, they have a couple of really smart people there, no doubt about it. The one brother is very good at what he does. I don't know that he does much of it anymore. But you know, they hire a bunch of junior analysts, 20-somethings and 30-somethings, and they have them crank out articles that are not very insightful in most cases. They don't have experience, and I think that in general they're okay. I don't think they're awesome. I don't think they're bad. Just think they're okay. They're in the middle. For $99 a year, the small cap gems is the one you want to buy because you should be learning about small caps. And every now and then you find one. And you shouldn't buy all their recommendations because they have to put them out. You should find the 1 or 2 or 3 or 4 a year that's worth 99 or $199, and that's what you do with them. All right. But I don't think there's nothing else they do that's worthwhile to me. Remember, I wrote for them and I got to know what they were doing, how they converted from blogging to having their own staff. I want all of my calls on the oil and gas on the oil to double. I'm looking for doubles and triples. Yeah, I'm not worried about Pioneer. You know, they're gonna sell more stuff. They got a good position. Yeah, I just can't see Pioneer being a problem. I like all these oil calls. I do. And like I said, you got to scale in slowly for the volatility. And when I put a price in there, It's very rare that I pay more than the price I tell you. I did pay a couple extra nickels for Centennial, but I think I think there was just a thin market, and I think with us doing it, I think we actually created a market, and I think that we made it a little bit more expensive on ourselves. So what we need is for Centennial to perform. And the reason I took January calls instead of like October calls is because I want not only these earnings, but I want the October November earnings in there too, right? And I am looking at a potential event driven thing here. And the reason we use calls is because we can put 1 or 2% of our portfolio into these calls versus 4, 5, 6, 7, 8% into the stock. Right? They're cheap. If they hit a home run, they hit a home run. Drop a couple points to the portfolio. Point here, a point there, you add it all up. I said this earlier. Point here, a point there. And all of a sudden, you're like, huh, not a lot of my stocks went up a lot, but all of a sudden I got 20, 30% return. And if you're in equities, you need to target at least a 15% return per year because the risk is too big not to. All these folks who are comfortable with single digit returns, they're dumb, just flat out dumb. There's too much risk to be in equities for a single digit return. You target 15 to 25%. If you get lucky, you make more. Right? And if you're really diligent over a long period of time, you'll have a lot of years in that 15 to 25% range. And you'll have a couple of years that are bad in the market and you lose a couple bucks, but you don't get creamed because my philosophy is to hold extra cash, not to have everything at risk. Because when unexpected things happen, which they do, that's why they're unexpected, you can go out and buy with that cash. All right, long call today. We have to stop doing this. It's so long. But man, there was like 50 questions. So, all right, we'll let you go. Have a good weekend. And you didn't give us a guidance price for. Yeah, I'll write something about these calls. All right, take it easy, guys. Have a great weekend, and ladies.